Jeff Fratarcangeli here, Fratarcangeli Wealth Management, for another live market update and call to action. Those of you that are joining us for the first time, Fratarcangeli Wealth Management has been in place for 30 years as of this year, and we're comprised of over 40 professionals with over 300 years of experience. We do more than just advising on investments. We look at the full financial picture of our clients that are comprised of athletes and entertainers and business owners, business executives, and many of the like. And we look at all sides of their financial picture, ranging from their taxes to their estate planning, to their benefits and costs that come with benefits, to the opposite side of the balance sheet of assets, which is their liabilities, helping them guide, counsel them, and make decisions that are focused on the goals at hand, as well as the objectives in the future, ranging from retirement to legacy and everywhere, starting with where we're at today. And it's our job and our role of being here to use our experience to help you make decisions that are going to be impactful to the outcome of what you're trying to achieve, and taking the emotion out of it and focused on the objectives and making sure that fear and greed do not drive our decision making. And bad news in my world is good news for the long term if we take advantage of it. That being said, I'm very proud of my team that we've been developing since 1995. We were recently this year ranked #1 in the state of Michigan and the other states that we're attached to by Forbes. We've also been updated and increased our ranking to 22 in the nation, and I'm so proud of my team that's very focused and has a culture of caring for our clients. What do they say? They don't care what you know until they know how much you care. And I can tell you our team truly puts it out there and gives it everything they have. And what we also do through our platform and our custodian at Wells Fargo is we leverage the network of individuals that I've been able to learn from and get to know over the years. And we have some folks that we go to at times like this, when here we sit today, we have tariffs. We have the big, beautiful bill, tax bill uncertainty. We have, of course, the Middle East concerns with Iran and Israel, and of course, the events this weekend and all that could come from this weekend's actions taken by our administration. And just kind of taking a step back, realizing that here we sit today within 3% of all-time highs that we hit in February. Can you believe that if we go back to April 8th, when we were down roughly 13 to 14%, that we've climbed all the way back to positive territory? And the main polarizing factors have been AI and tariffs, and the uncertainty of the unknown relative to tariffs and other factors. And of course, now the big, beautiful bill that's pending. So I bring on two folks that many of you have known, whether it be on our periodic updates or seeing them on CNBC or other publications. Quick introduction that they probably don't need any introduction. My first guest is Ron Insana, a CNBC contributor, someone that I've had the benefit of knowing for now going back 5 years personally, leveraging your brain, your experience. And I think the biggest aspect, other than the books and the fact that you've run a hedge fund and the fact that you've worked in Washington, is that you can take and glean information and experience from Wall Street, Main Street, and Washington and interpret it and funnel it through in a very well-articulated fashion, and helping us see through the smoke and smog as to what we should and could be doing to be prepared for what's around the corner. And I appreciate you always, Ron. And my second guest, Bob Carey. Bob's someone that I've gotten to know, gosh, for decades. I remember vividly, it was approximately 2016, and it was very dark. It doesn't feel that way now in retrospect relative to the markets since then, but everyone was putting their money into treasuries. We were on the heels of the 2008 that went all the way through 2012 market collapse and financial recession that was like no other in our generation. And I remember you saying to us that more money has gone into treasuries than equity markets, to an extreme that just simply did not make sense when you looked at the risk reward relative to the current markets, public, as well as the treasury and fixed income markets. And I remember sitting there saying, man, this guy's an outlier, because we're hearing everything quite the opposite. I think we all know that the markets have substantially risen since then. We've had doubles. We've had market performance like I would say compares to any other bull market. And so I appreciate you, Bob. You're a chief market strategist at one of the most respected research and investment firms called First Trust that we've benefited from for years. You're a CFA by education, out of the graduate of University of Illinois of Champaign, and with a degree in physics as well as business. You also are featured on many different publications, Bloomberg TV, CNBC, and many of the like. And you've been a great partner to us, as your firm has, and I appreciate you. And, like I said, we're sitting here today. We have tariffs. We have the big, beautiful bill. We had the events in Iran and Israel that continue, and I believe a ceasefire and all sorts of things that come from it. And I'm going to start with you, Ron, if you don't mind. We have the situation that it's geopolitical in nature, notwithstanding how critical knowing who has nuclear capabilities. Can you help us frame the conflict in terms of Trump's Middle East visit the last 3 weeks? And are we moving more towards stability or what in that area of what we've seen for conflict well before we were ever here? What says you, Ron?
Well, in the longer run, I'm not sure. In the shorter run, I mean, this to me, the behavior of the markets is very much reminiscent to the very first Gulf War. We saw oil prices move up from May of 1990 to the end of July of 1991. And on August 2nd, Saddam Hussein goes into Kuwait, totally unexpected, and oil prices continue to rise until the U.S. battle plans were completed to liberate Kuwait from Saddam Hussein, and oil prices went down and actually crashed on the first day of the war, January 17th, 1991. And very similarly, this time around, we saw oil go up about, from $57 on May 5th to $78. And then as soon as we attacked Iran and hit their various nuclear installations with bunker busting bombs, oil prices promptly plunged. And it's exactly what we saw to a lesser extent than we saw on January 17th, 1991. Oil fell 33%. The Dow rallied 7% the first day of the Gulf War. Here, we had a kind of a semi-similar situation, and oil fell 9% on the day after the attack, and the S&P was up 3.7%. So the markets seem to think that this is, in a certain sense, kind of a one and done involvement as far as the United States is concerned. Now, whether or not we've permanently set back Iran's nuclear ambitions, whether or not there'll be further hostilities in the Middle East, that's for someone else maybe to answer. I'm not that kind of expert. But for now, as you indicated, I mean, we're within striking distance of an all-time high on the S&P, and oil prices have come down meaningfully from 78 to about $66. So I think I don't want to call it an all clear because I think that might be overstating it a little bit, but certainly we're in a relatively safe spot for the moment, unless or until something gets derailed.
I think you mentioned it, but if you can expand upon where do you think oil prices, production, and that, of course, quite a polarized discussion around the port that has been under question. How can that play out in your view?
Well, I think you'd have to see more, military action for the Strait of Hormuz to be closed by Iran. Over the weekend, the Iranian parliament had voted to close it, but that's really not up to them. It's up to the Supreme Ruling Council, and they never said that they were going to do that. So ships have been moving in and out of that strait, and that's 20% of all the world's oil that goes through that Strait of Hormuz and out through the Persian Gulf. President Trump said China, although I think they've been doing this anyway, could buy Iranian oil. Iran sells about 2 million barrels a day of oil to China, so there's no disruption there. And so the price has settled now in the mid 60s. I suspect it will probably hold there for a while. U.S. production for the moment has peaked. OPEC is producing more. And so I think we've kind of found an equilibrium price for oil somewhere in the $60 to $65 range. Again, unless or until there's a surprise in the Middle East where the war resumes, the ceasefire doesn't hold, and then you start to worry about real disruptions in the flow of oil around the world.
So we have the hope for a less of an impact or maybe an anemic impact, but we also have to focus on, as we always do, the worst case.
Yeah.
And we'll keep our eyes and ears peeled. As I mentioned, some of these things can be over exaggerated in the reaction and create opportunity. Who would have guessed on a weekend where we substantially bombed Iran in certain areas that we may have thought would happen, but maybe didn't believe would happen. And here we are in 2 days leading up into today with 600-700 point climbs in the market. And like you said, reaching new highs. And I'm going to turn to you, Bob. So here, as I mentioned, we're within a couple percentage points of an all-time high coming into today on the S&P 500, which, believe it or not, is up 3.5% year to date this morning at the open. We also had the recovery that I mentioned, and the major influences that I think have driven this market this year to be so down as well as recovered. We've learned a number of things, I think, staying the course, dollar cost averaging that I'll talk more about. But as the polarizing factors are still out there and they slowly trickle themselves in as the solutions potential, if not definitive, tariffs What is your feeling as how that will land and how the trade balance will essentially come through? What's your interpretation? U.S. production, how is that affected? Becoming more nationalist versus globalist. And what do you anticipate corporate earnings ultimately having as an impact for this year and next? And Ron, I may come to you on that as well. Go ahead, Bob.
Yeah, a lot of things going on with all of those, Jeff, that we just don't know exactly what kind of trade deals we're going to see at some point this year. I do think that this is maybe the most difficult thing to predict because of the nature of trade and the fact that we have so many different players from around the world who get to have a say in trade. Obviously, we know where Trump stands. He would like, I think ideally, he would like to get trade barriers down outside the U.S., but he has used, the threat or the actual increasing of tariffs on products from overseas to try to get what his objective might be. I think that ultimately that issue is going to be put to bed this year. I don't see President Trump wanting the trade issue to be an issue next year. I think this is something that he knows is tough. I think he'd like to get as much as he can this year, and I think the market is not quite as concerned about that. Certainly not anywhere near as concerned as it was back in April. I think ultimately, when we look at earnings estimates, they've come down a little bit since the beginning of the year. Estimates actually for next year seem to be holding up a little bit better. So there seems to be a little bit more optimism that some of these issues will get past us this year. And when looking ahead to next year, we might see lower interest rates. We might have lower taxes. If this bill does pass, I think it's possible that we'll see a fairly meaningful reduction in corporate tax rates, which would help profitability as well. So I think ultimately, the price of oil going down that Ron mentioned, the fact that Treasury rates are lower than they were a few weeks ago, I think all of that is helping sustain the market. And we are going to need the Fed at some point probably to cut rates, and that's another discussion as well. So a lot of things going on, but I think ultimately the market is giving us some all clear, which is we never get that message exactly, but certainly the market is a lot more comfortable now. We're feeling a lot more comfortable about all those issues compared to where they were a few months ago.
You covered a lot there in a tight window of facts. You talked about the big beautiful bill and the market sort of anticipating lower corporate rates and potentially staying pat on personal rates, which lends to economic activity and discretionary spending. You talked about the interest rate environment, the 10-year down to 4.3%. We've seen that range between 4, almost 5 at some point, which feels like a lifetime ago.
Yeah,
within the last
it wasn't
12
that
months.
many weeks ago. We were talking about 5. Yeah.
Yeah.
What a shift.
And let me for a second, and I'm going to come back to you. What would you expand upon, or what would you say, Ron, to add to, or maybe just give your opinion different or the same relative to these factors, mainly trade, but taxes and interest rates, if you don't mind?
Yeah, I'll start. I'll go in backwards order. Interest rates, we're starting to get some indication from a couple different Fed officials, including the vice chair who oversees financial regulation, that there's a desire among some officials to start cutting as early as July, though Jay Powell yesterday and today said he's willing to wait. So I'm going to give the nod to Jay Powell, the chairman of the Fed, that he's not going to be outvoted, and we'll see rate cuts maybe September, October, November, around there. With respect to the big beautiful bill, I don't see lower corporate rates in there. In fact, I don't think lower corporate rates were written into the bill. Originally, the president wanted to get them from 21 to 15%. I don't believe that's in there. So it's really an extension of the existing set of tax rates
Clarity.
we have. So I think it's not as much of a stimulant as many would like. And I think there's certain aspects of it that could slow growth, the cuts in Medicaid, which would put healthcare burden costs on the bottom 10% of income earners, and any reduction in food stamps might do the same thing. So I'm a little bit more bearish about the impact of the tax bill. On trade, I think it's a coin flip where the president has expressed for quite a long time his philosophical view of tariffs, that they are a source of income, and they have been for the U.S. government. We've collected about $22 billion in tariff income or import taxes since the imposition of these tariffs. And I think he fundamentally believes that U.S. tariffs should be higher than where they've been, roughly at 2.5% over the last many years, and now sitting on average at about 15%. They'll probably get pushed back down to around 10. The impact on trade, though, has been uneven. We're not sure how corporations are going to respond. A lot of them pulled in a lot of imports before the tariffs were imported, so we haven't seen prices go up because they have inexpensive inventory that they're still, working through. Down the road in the third and fourth quarter, we might see a one-time pop in prices that would scare the Fed a little bit, and keep them from lowering interest rates. But I think that's up in the air. It's really hard to tell. And even Jay Powell, the chair of the Federal Reserve, suggested that he was uncertain as to what the impact would be, and he's really waiting to see before he makes a decision. And so I'm not going to second guess him on that. I would tend to agree with him that we don't really know how corporations are going to deal with this, pricing pressure. Will they just eat the price increases that come from import taxes and take thinner margins, or will they pass those prices along on a one-time basis to consumers and have, an elevated level of prices for a very brief time, and then the inflation rate itself stabilizes? So I don't have a full answer, particularly on the trade front. The president has been fairly committed to this for a while. We'll see, as Bob was saying, whether in an election year he wants to, stand fast on that, or maybe get a little relief before the midterms.
An election year, Ron, really?
Next year.
He lowered rates in December. He lowered rates in November. We had inflationary numbers going higher. Today we have the CPI number coming in at 0.01 compared to zero point 0.1 versus 0.3 increase April. And we're concerned about unemployment, opposite of what we were.
Yep.
But during an election year, we lowered rates how many times last year? Now we're not. It just seems odd to me. I understand the uncertainty, but when hasn't there been uncertainty relative to where we're going next with economic activity? But that being said, I appreciate your opinion. That's why I have you here, because my opinion may be different, and that's why I'd like to hear it from others. Let me ask you this, Bob. Sectors, right? So what sectors do you like the most in light of the situation that we are still in the midst of with uncertainty, valuations, and really where we're going next, if you will, on the expansion that I believe is coming? I'm curious as to what you think.
Yeah, when we look at valuations right now, we definitely have seen the tech-related, the media tech related names have definitely gotten a little expensive here. I do think that rates are helping. If I plug in a 4.3% 10-year on earnings estimates for the tech sector, for example, it helps explain why we've had the big move that we've had in some of these names. The AI story is very much intact, and I think it extends so far beyond just what we know now. I think as we go through the year, I think we are going to see CapEx in the electric utility space improve substantially. We've got news today that 3 Mile Island is going to be coming back online in 2027, which, that to me is, I was in high school when that happened. And if you told me it would take 45 years to bring that plant back online, and then you find out that they're going to sell substantially all of that to one company, Microsoft, as I understand it. So, that's just remarkable. I get asked all the time, is this AI stuff for real? And I'm guessing that a major utility like Constellation, a company like Microsoft, they wouldn't be spending this kind of money if they didn't see AI taking shape going forward. So, and you couple that with, I would submit a fairly successful launch, at least test launch for Tesla and its robotaxi program. That was kind of fascinating to me to watch over the last couple of days. So a lot of things that in the end, I think the demand for technology spending, I think that story is very much intact. I think most portfolios are probably built around that quite a bit to a great extent. And I think increasingly these other sectors such as utilities, maybe manufacturing, industrial, I think some of those companies are going to benefit from this as well. So we need to upgrade the grid in the U.S. I think that's been a big story. We are going to need security on our data. Cybersecurity plays, I think, look attractive as well. So a lot of things related to that. The obvious answer is just to buy a handful of these chip companies that are seen as pure plays for AI. But I think what we're learning is that this is something that extends far beyond just a handful of those companies.
Well put. So listen, the AI story is real. The benefits of where it's going, I'm going to ask in a second, relative to the benefactors, not the companies that are actually building the infrastructure or giving us the technology, which I am going to look to you all on. But listen, I've been sitting here since 1995. and I was watching the internet unfold prior to that. We thought we knew what it was going to do. We had no clue. This conversation is happening because the impact that that's brought, not to mention the information flowing in a fashion that we could never have fathomed. I used to have stacks of paper on my desk. We would get information minutes, if not 10 minutes or longer, after folks in New York would receive it. And Ron, you know this best because you were getting it and feeding it to us. This is going to be far more explosive and impactful. But I had post-traumatic stress when they started talking about DeepSeek and how it was going to take over NVIDIA, which turned out to be a bust, if not a complete non-factor. We'll get into that. But the post-traumatic stress of the bubble of 1999 and 2000, and of course, the decade that was lost, that we endured post that overreaction and overexuberation, as Greenspan put it. What do we have to be prepared for, and how do we operate differently, or what do we learn from our experiences? I'm going to start with you, Ron, as it relates to the AI implementation and just protection modes that we need to consider as this thing does take off in more fashion than I think it already has.
Yeah, and as we sit here, NVIDIA is making a new all-time high, even as you mentioned, DeepSeek, which, by the way, most of us who have looked into it, realize that they spent some significant amounts of money on the front end of this with very expensive chips, and the back end was done inexpensively. So the whole thing wasn't quite as cheap as it was made out to be, and possibly nor as powerful. I think when you look at this and compare it to the days of the internet, 95 to 2000, we're probably around mid-course, 97, ish, where in those days we were talking about the pick and shovel companies in the internet days, the ones that were building it out, the infrastructure plays. We're getting past that stage now and moving towards applied artificial intelligence and how it's going to affect law firms, how it's going to affect medicine, how it's going to affect financial services, what it's going to do in terms of back office operations. Is it going to help make investment decisions or medical decisions or improve things like, radiology, and will it help lawyers cut down on the need for paralegals because ChatGPT can read a brief, summarize it, and give it to you in a nanosecond. And I think we're making the transition to that stage. So I don't think we're actually in a bubble. And particularly with these hyperscalers that everybody's so concerned about with respect to price and valuation. If you remember the early days of the internet, we had companies that had no profits, no revenues, raising a ton of money that before they even had a product. And this is a very different environment. The big companies that are making new highs, like Microsoft and NVIDIA, and even Apple, although it's having some, at least short-term issues here, they are cash rich. They are very, very strong operating companies that have a very, very long history. They're not new. And they've evolved and in fact revolutionized their businesses. So they're very solid. Now, whether or not they're overvalued is a separate question. But I think we're only about halfway through this process. If there is going to be a bubble, it's a couple of years away. And if there is going to be a bubble, there are other places that I'm looking where there might be more vulnerabilities than there are in the technology sector at the moment.
Excellent, Ron. Thank you for your insight. I think the one takeaway that I'm going to come back to is the fact that you feel we're in mid-97. And to remind our audience what happened for the next 2 years, it was explosive. Yeah. It was I was hoping you were going to say 94, to be honest, because that would be even better.
I think that's a little early. In 94, we didn't even know about AOL. So
yeah. Well, I just remember watching the market take off at the NASDAQ was the cat. Everyone was saying, what's the Dow mean when the NASDAQ's running as hard as it had? So I was interviewing for a job in my industry, so I was a little bit more in tune then than I had been. So I appreciate your insight on that. How would you expand upon that, Bob? What would your take be on that? How would you be approaching protecting but yet being opportunistic simultaneously? How would you play this market?
Yeah, there's certainly a lot more products and tools and strategies that are available now that allow you to protect the gains that you have, at a cost of maybe some upside potential. But I think that's been the one thing about our side of the industry is watching all of these products come to marketplace. I do think investors realize increasingly that they need to have capital for the long term. They need to stay invested. But at the same time, we all know that volatility can crop up, and when it does, it makes us do things that we shouldn't do sometimes. I love what Ron said about where we're at today compared to where we were maybe in the 1990s. Just to give you some numbers, one of the things that I calculate that I think is critical to understand understanding is the returns on capital at the corporate level. The stock market consists of, all these businesses that have balance sheets. These companies make investments. These companies, that's really what we're betting on as investors, is whether or not these companies make good investments. And right now, the rate of return on balance sheets is at an all-time high. We have never seen companies, particularly here in the United States, generate the kind of returns on capital that we see today. The returns on capital used to average about 6% many, many years ago. And really, in the last 25 to 30 years, as the internet, I think, has proliferated, has made businesses more efficient, all of that, I think ultimately that has led to massive gains in productivity. And now we've got rates of return in the range of 10 to 10.5% for companies here in the US. So, it used to be not unusual for interest rates to be about at the same level as returns on balance sheets. You go back to the mid 80s when I started my career, major retailers such as Sears and Kmart at the time had rates of return on capital that were about equal to what treasury rates were. So today we've got substantially higher rates of return at the corporate level compared to where interest rates are and the cost of capital. There's a lot of different ways of calculating that, but I think ultimately the market cares about returns on capital and the cost of capital. And that spread is still very, very high, even after interest rates haven't gone up the last 3 or 4 years compared to where they were before.
Bob, you attribute that to productivity due to technological advancements? Is that?
Yeah, no doubt about it.
We haven't even touched the surface on that yet relative to this next chapter.
Yeah, and that's where the AI thing, I think, becomes kind of interesting, because I think, it's really all about doing more with less. And that's what companies, if they're successful, it's those companies that allow, to sell products and services that allow companies to get more productive. And then it's, of course, companies actually implementing those new services, those new software programs, all these different things. It's a very exciting time, I think, for all of this.
Listen, I'm just going to take a step back and just sort of summarize what I just heard you say, which I think is critical. We've been hearing about this year something called stagflation, which is low productivity and high inflation, which is the worst formula for where we're trying to go with this expansion that we hope to have globally and as well domestically. And we saw Japan go through that for decades, right? And what I hear you say, which I think the market's sort of speaking to as well, is productivity spiking due to efficiencies and the cost of doing business coming down, which is the perfect storm as opposed to the imperfect storm of stagflation. And that's what technological advancements brought with the first chapter of the, call it internet. And the second chapter we'll call the AI explosion. And I think that is so powerful. And I also heard, listen, the companies that are bringing technology are certainly benefactors initially. But then you have the infrastructure that needs to be laid out, industrials, utilities, et cetera. And I've heard that, and I tend to agree. I had the benefit of having dinner with Larry Ellison about a month ago, and had the opportunity to pick his brain about what he saw coming in technology, as he's the founder of Oracle. And his comments to me were they hit home, if you will. And the fact that they were spending all their free cash flow on data centers this year says everything. And I think you just said the same thing with Microsoft and the 3 Mile Island. So if the smartest minds, the most successful minds, the certainly more capable minds are taking action. Microsoft, for example, in this category, they're putting their money where their mouth is. I think that it's hard to argue what's coming next. And so let me pause there. I just think that was powerful. And Ron, I'd love to get your take on it, having been on the front lines, representing us on CNBC, on Wall Street, on Main Street, and in Washington. What do you see, if any, different? And how would you put your spin on where you think we are and where we're going?
Yeah, I think, it's going to be slightly more selective going forward with respect to, how investors allocate their capital in the technology space. And again, I think, there'll be a move towards, in addition to, the electrical build out that's required, the data warehousing and all of that, the applied uses of artificial intelligence in law, medicine, and finance, as I said. I'm somewhat more hedged from a philosophical perspective. In January, I wrote a piece for CNBC.com about moving about 10% of your money into Europe as a tactical trade, because they were starting to outperform. And however you want to characterize it, whether President Trump has pressured them into this situation or whether it was something they were ultimately going to do anyway, you now have NATO members spending 5% of GDP on their defense. You have Germany reflating its economy and spending $1 trillion on infrastructure and defense material. And you're seeing that across Europe. And so if they're going to reflate, and they're outperforming us rather handily this year, the European Dow is up 17% to our 3% in the S&P. I would keep an eye on other parts of the world that may be benefiting from this as well. It's not just going to happen in the US. It's going to be a worldwide phenomenon. I'm always very, I would say, reticent to deal with China, even though they may be very involved in with respect to AI and other, technological advances. I don't love their markets. I don't love their rules, but I am intrigued by what Europe is doing and trying to catch up, both in terms of infrastructure and defense after, for a wide variety of good reasons post World War II, why they didn't spend that money. They're now starting to spend it. And I think it's going to be an interesting play. They're very, very far behind on technology. And if they start to actually invest some money there, there could be some interesting opportunity sets as well. But I still like the U.S., but I do think that for diversification purposes, tactical allocations and switching a little money into a place that might start to reaccelerate. And the European Central Bank's already cut rates 10 times, I believe, in the last many months. They've got a little tailwind that we at the moment don't have. So that's more of a tactical trade, but still aligned with Bob's view. There are a lot of places that are going to benefit from technology. By the way, not just 3 Mile Island, but New York State approved its first nuclear power plant in, I believe, 50 years. They're going to break ground on that over the course of the next several years. So we're moving in that direction as well. So nuclear and modular nuclear here in the U.S. could be a very interesting play too.
Interesting. Well, Europe and the world market in general has underperformed the U.S. market since 2017 by, in many cases, double digits. And so the fact that they've had such a nice year this year is welcomed. And I think it makes sense relative to value opportunity. Let's not forget, I think we all anticipate or at least hope for a more calm geopolitical environment, which should lend itself to some of the inflationary headwinds that Europe's been dealing with cost of energy and such, somewhat dissipating, which brings, and listen, I'm taking my family to Europe next week for a family trip. And, I know that many people are doing a lot of international travel. And I know that when I was there a year ago, it was packed. And I understand it's even more. So the fact that money's being spent there and folks are enjoying different parts of the world. I'm going to be, I tell you what, my wife will add to the retail sales that they'll be enduring.
GDP of Italy.
Oh, I would bet big that they'll continue to thrive. But, I think on that note, okay, we see a lot of positive things. And if I remember back to the impact of the explosion of the internet and how it affected our budget balancing, and, it seems so long ago. For many of us, it is. For me, it feels like not that long ago. But we have a $37 trillion deficit that continues to compound, and it makes me dizzy thinking about it. And the U.S. dollar's been under pressure. I think a lot of that has to do with the situation that we're seeing unfold with the geopolitical unrest and hopefully the calming of that. But certainly that's impacting the international markets. We know that, right? We've had a tough dollar. I think the uncertainty and the let's buy more now and import now because we don't know what the tariffs are going to be. We know where they are today. All of this could be playing into it. If I could just get both of you to give me a couple minutes, if not just a to the point feedback on how you think this plays out. What are the concerns? How do we play this, if at all? Why don't we stick with you, Ron, and then we'll go to Bob.
Well, look, I mean, the annual deficits in the national debt, if the big beautiful bill gets passed, will not be coming down anytime soon, and neither party appears interested in reducing either the deficit or the debt at the moment, right? I mean, the best estimate that we have, if this package passes and President Trump signs it, although there's a wide disparity between the House version and the Senate version, is $3.4 trillion added to the national debt over the next 10 years, even with the spending cuts included and assuming 1.8% annual growth over the next 10 years. So, nobody's really that interested in it. The dollar has come under pressure. What's really interesting is that internationally, gold is now the second largest reserve holding of central banks around the world, behind the US dollar. So there is a little risk there that if we were to do something unwise with respect to how we finance the deficit or how we calculate future debts. There's some move in the Senate to suggest that the extension of these cuts will not increase the debt over time because we're simply moving along the same baseline and that we already forecast. If you start to get into trickery like that, that could put some real downward pressure on the dollar and increase the value of gold. So I'd be very wary about how this is all being calculated. Having said that, and you and I, Jeff, have talked about this, I'll do this very quickly, in the past, this is still a relative game. I mean, China has a larger debt to GDP ratio than we do. Japan does, Italy does, and France does, I believe. And so, we're not the only bad house in the neighborhood, as it were. In fact, we might be the best house in the bad neighborhood. So while I'm concerned about it and while I believe it needs to be addressed, I'm not sure that, absent a big mistake, that we're going to be the first one to go.
The old saying, you might be out of shape and you might be tired, but the competition's even more out of shape and tired.
Yeah.
I think Germany's the only one right now that gives us some comparable that we want to get to. But Bob, what says you?
Yeah, I'm watching these treasury auctions very closely, and I think that to me is the ultimate gauge of whether or not we can finance these deficits long term. And this is information that's not hard to find. Every quarter, the Treasury comes to market and says, "Hey, we're gonna auction off these securities," and we watch the bids and we see essentially how many bids we get compared to what we're auctioning off, and we still have plenty of folks that are more than willing to buy our treasuries at this point. Maybe demand has slipped a little bit in the last couple of years. I do think that is something that has the attention of the Treasury to some extent. But I think at the end of the day, as we've all said, I mean, the U.S. we really do have a unique place. We're still far and away the largest economy in the world. We have a Fed that is holding interest rates at the same time that other central banks are cutting interest rates. I think in theory, the dollar should maybe be a little bit stronger in that environment. And maybe if the Fed doesn't cut rates dramatically here over the next 6 to 12 months, I think it's pretty reasonable to expect that we're going to get some rate cuts, at least one this year, maybe two. I think the market eventually will realize that we are still taking inflation seriously and our reserve currency status seriously. So it's not ideal to see these deficits, but so far we've been able to finance them.
Good points. And I agree on the dollar as well. At least I logically see how that does come to fruition. I'm just going to do a brief summary. I think the one thing that sticks with me is the mid-1970s, 1997 comparable to where we're at relative to the expansion of this new technology that I think is going to be even more impactful and explosive. I think your comments, Bob, in reference to the fact that, the productivity increase and the lower cost of doing business is critical. And that's what technology's brought. And I like to use the example of the internet replacing the Dewey Decimal System in the library as a kind of a low-level comparison versus the AI kind of taking every library and every bit of information combined and solving the pressing issues that we have with that information instantaneous, whether it's transferring money from one side of the earth to the other in seconds versus weeks, or autonomous vehicles, the taxi, or just these bots that I'm told by some folks at the top level of technology say there are going to be more bots on this earth than humans within 5 years. Hard to fathom, but you know what? If someone told you in 1994 what the internet was going to do, would you have believed them? And we didn't. So there you go. I also have heard a number of factors like diversification and international. We talked about the market with uncertainty creating wide volatility. We talked about staying invested or not making emotional reactions. I also heard you say, Bob, having cash to take advantage and sometimes doing what the hardest thing to do is, which is buy rather than react in a negative fashion. I look back and think about who we bring to these discussions, and I know I've chosen the right two tandem, and I think you're coming from two polar opposites in many ways of your opinions historically. And I'm going to ask you this before I summarize with our call to action, and you can take it any way you want. I'm not setting a tone as to what you tell me. I'm asking you to give my audience and give us the opportunity to learn and leverage your knowledge, your experiences with a couple minutes, if you don't mind. And I'll start with you, Ron.
Right. I would say that, while I'm, reasonably bullish on the outlook, I'm still slightly concerned about the risk of stagflation. That hasn't left my head yet, with respect to tariffs and trade, whether or not we can get the 90 deals in 90 days or 20 deals in 20 days, whatever that happens to be, and how the president responds to any intransigence on the part of our trading partners with respect to whether tariffs will go up or down. And then worried that the Federal Reserve will hold steady, not cut interest rates at a time while the economy may, from a labor market perspective, might also be slowing down. So I haven't ruled that out in the second half of the year yet. And so I'm watching important statistics around both those areas as closely as I can to make sure that that is not the scenario that plays out, that we're not in some ways recreating a small scale version of the 1970s. And geopolitics plays into that as well. So we need to clear some of the geopolitical risk as well to make sure that that scenario stays off the table. If we achieve all that, then I think it's smoother sailing for the remainder of the year, and you get better performance out of the equity markets if that's the case.
Very good, Ron. Thank you so much. Bob.
All right, just one quick final thought. I read the other day that that Hallmark sells 500 cards a day for people turning 100 in the U.S., which is pretty extraordinary. Can you imagine Willard Scott today if he had to read 500 cards?
Yeah, we don't have anybody at the Today Show who's doing that anymore.
Exactly. I think it kind of ties back to what I said earlier about making sure that you've got capital for the long term, and that simply means taking some risk. It means having some equities for the long term. I started my career in the mid 80s, and I saw a lot of folks retire and get completely out of equities and go into fixed income at the time. And we had, I would say higher yields. We had attractive yields by comparison to where we're at today back then. And so you could argue that it made some sense, but we also had people, not living as long as they live today. So I think the one.
Look, in this day and age, we have technical difficulties.
And it was right as he was hitting the 1 point.
Oh my goodness!
Extremely important. There he's back.
All right, Bob. We got to get
you.
Oh,
did you lose me?
We lost you, and you were about to hit a. I think you were really right there to. Tell us something we never heard before. It's disruptive. But go ahead, please.
No, it's to me, it's just common sense. I think it's about planning for the long term and having some capital. We had a lot of folks retiring. And not living all that long, and it made sense to get conservative, maybe have more fixed income, and I think investors are going to need capital in the event that, God willing, they end up living into their 90s and beyond. I think it's going to become a lot more common here as we go forward.
Listen, if AI is going to do what it says it's going to do, I think 90 is a low number. If we're going to get more efficient and capable of productivity and doing it at a lower cost, and we would hope that healthcare would play a role in this impact. We haven't even talked about that. I will say I'm hearing some pretty interesting things out there from some folks at the top levels in direct involvement in investments and research and such. And I'm not going to go there today because it's a whole other conversation. But I will thank you both, and I'll say it again in a moment. But what is our call to action? Okay, listen. Having worked in this field for 30 years, giving it everything I have, and my team with support and doing the same, and having folks like you and resources like yours to leverage and learn from, I will say this: two things that have been consistent. One, making sure we have enough cash for the foreseen and the unforeseen, making sure we have enough liquidity, because 08 will come again. We will have a situation like 08 again. But Ron thinks there's a chance potentially this year. Tend to see something different relative to what the market's saying. But what I do believe is it will happen again. And we need to be able to overcome and pay our expenses and not have to foreclose and stay the course. So having more cash for what we know to be the case over the next 2 years, and enough cash to carry us through the next 3 years, because if I've learned anything, whatever we're going to go through, we'll get through it 3 years or beyond. And then make sure, like Bob said, make sure you're combating the cost of living and you have money that's going to last you. We need to make sure that we're investing for the long term. We separate the two. We prepare for the worst and plan for the best. And we've learned that we do not react to fear or greed. We don't buy when we should be selling, and we don't sell when we should be buying. This year was a prime example of dollar cost averaging, staying the course, having a plan of what we need to have liquid and what our allocation is appropriately aligned to relative to our near-term and long-term goals, and do not react. We are methodical and we execute and we leverage everything we have to get prepared for the next turn of whether it be technology, market activity, what we've learned from a 4-year, first-year term president, and what happens first, second, third, and fourth year. We leverage what we learned from the internet. We leverage what we've learned from history, and we protect. That's our number one objective. And I appreciate you both. I thank you. You've been a phenomenal guest as always. You make my job capable of being able to execute and leverage your minds and your experience, and hearing it from you will help my audience. And I thank you. I thank everybody, and I will see you soon. Be well.